Welcome, everyone. My name is Gretchen Schmitz, and I'm with Transition Advisors. Our webinar today is Succession Planning and Alternative Deal Structures. Before we begin, we need to go over a few important items. First, please close all other programs running on your computer. This will help ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order for you to receive your 1.2 CPE credits, you must complete two requirements. First, you must participate in all 4 polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation. Partial credit will be given for those answering 3 of the 4 polls. Next, you must complete an online evaluation that will appear on your screen immediately at the end of the webinar. Please do not close your browser before completing this survey. Once these requirements are met, the certificate will be emailed to you within 10 working days. In order to fully participate in the webinar, please familiarize yourself with your GoToWebinar control panel on the right-hand side of your screen. The orange arrow on the top of the control panel is to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box towards the bottom of your control panel. Just type your question in the box and click Send. Joe will also be sharing his webcam during today's presentation. You are welcome to resize, minimize, or even close this if you wish. Finally, I'd like to remind you that Transition Advisors is a free CPE webinar each month. Our upcoming sessions include Growing Your Firm Through M&A on August 17th, a 2 CPE class on succession planning and valuing your firm on September 28th, and a brand new webinar called Case Studies on Internal Succession of Retiring Partners on October 25th. To register, visit the CPE Courses section of Transition Advisors. This will bring us to our first polling question of the day. How many equity partners do you have in your firm? I'll give you a minute to fill these out. Okay, I'm going to go ahead and close the poll. The poll response is 50% 2 to 4, 33% 1, and the other 3 have not added any sign-in. As a reminder, you will receive a link in the email reminder today to download a copy of this presentation. I send you the same link just now via the chat function. Now I'd like to introduce our presenter for today's session, Joel Sinkin, President of Transition Advisors. Thank you and enjoy the webinar.
Hello, everybody, and welcome back to another session. Today, we're going to focus on succession planning and alternative deal structures that you can use to create a succession plan. You know, I'd never like to, let's start, by the way, with our first polling question. Obviously, the majority of you on the phone today and online are smaller firms. So we're going to focus heavily on the smaller firms, but still bring value to some of the larger firm types of deals. You know, I never turn a CPE class into an infomercial. But I do think it's important to understand the perspective of the speaker. For the last 27 years, the only thing I've done is help accounting firms in growth and succession strategies through mergers and acquisitions of CPA firms. We're a very, very focused national firm, handling only those types of things. One of the things I always start every session with is if there's 50 things you need to know about any type of transaction, in this case succession planning and alternative deal structures, the smartest person in the room is going to think of 35. And we're not going to get you to 50 today. The reason for that is the unbelievable uniqueness of CPA firms. I could take 5 firms doing the same revenue with the same amount of staff, same amount of partners, and that might be the only 3 things they have in common. The uniqueness of our profession and the way people choose to run their practice can be very different. But today, we're going to focus on the parameters that most of these types of deals fall within. You know, I write the Journal of Accountancy and Accounting Today, and I'm an avid reader of publications in the profession. And there isn't one major magazine in the CPA world that comes out on a regular basis that doesn't spend some time on mergers and acquisitions. So one of the questions I often get is, why is the activity so high? Last year, Barry Melanson, the head of the AICPA, actually suggested that there'd be more mergers and acquisitions over the subsequent 3 years than in the history of the profession. So what's going on out there? Well, part of it's the economy. You know, in 2006 through 2008, we were growing like weeds. Our organic growth was substantial. The baby booming aging didn't really impact us yet. And M&A activity was there, but it wasn't a huge function. Then in 2008 and into 2009, the economy went sour and organic growth really started to diminish. As a result of that, the fastest way to grow is through a merger and acquisition, so it started to become more appealing today. Here in 2017, though, the driving factors, while still economic in many cases, have added features to them. For example, niche development. Many firms are taking on these cross-selling opportunities. You know, never before have we had more advisory services, wealth management, litigation support, business valuation, IT consulting, elder care. We could go on and on and on. Many firms are looking to take this bigger platform of services to a client base that hasn't been offered them, who are ripe for these cross-selling opportunities. Also, the IT has created an opportunity where we can make satellite offices so efficient and still operate almost as if we're one firm, that creating satellite offices has become more appealing. There's still synergies that can be done, and of course, cross-selling opportunities. You may have noticed that many of the large firm mergers over the last 2 years were what we call marketplace mergers. Someone wasn't in the Midwest who wanted to be, wasn't in New England who wanted to be. And this is a big part of it. But without any question, the driving factor behind the activity going on today is the aging of the baby boomers, of which I am one. You know, never before have we had a larger exodus that we expect of owners of CPA firms. Over 60% of current owners of CPA firms will be eligible or already are eligible for Social Security benefits within the next 5 years. And at the same time as this is going on, we're having the greatest talent shortage have ever faced. So we're losing a voluminous amount of the best talent, our founding partners and owners, we're losing over the next several years at a time we have the least or smallest crop of potential successors. So this is a big factor in driving this M&A marketplace. What a lot of people seem to ask me is, with all this activity, is it a buyer or is it a seller's marketplace? It's a very appropriate, lucid question. The answer is not as simple, but there's definitely an answer. You know, one of the things that we start with is location. There are different parts of the country that have different impacts on, is it a buyer or seller's marketplace? For example, I'm speaking to you today from Long Island, New York. I know you probably thought based on my accent I was from Georgia, but I was teasing you all. I'm actually from New York. And I'm right next to Nassau County, Long Island. Nassau County has over 3,000 CPA firms, more than the island of Manhattan. There's more accountants on Manhattan. There's more accounting firms on Long Island. If you had a $500,000 practice and you were in Nassau County, Long Island, there are so many firms that are large enough to absorb you with no incremental increases in overhead. It's very much a seller's marketplace. Values have come down. You know, 25 years ago, we were seeing 1.5 to 2 times. 10 years ago, 1.5. Now we're fighting for the 1.25 in this high demand area. But it's still of great demand. If you're 3 hours outside of Boise, Idaho, you're in some of the most beautiful country we have, but there may be one accountant for every 3 zip codes, in which case it's a buyer's marketplace, supply and demand. I recently was teaching some CPE in Las Vegas for the AICPA Engage conference. And a gentleman came up to me and said, I would never buy my competitor because there's nobody else but the 2 of us. And if he retired, the clients would have no other place to go but me. In that case, it's a buyer's marketplace. Where the biggest change has probably occurred is in the $3 to $10 million firm. That's where it already has become, for the most part, a buyer's marketplace. Let me share with you a little bit more information on that. Look at an area of the country like Boston. Boston's a big little city. There's about 40 firms between 3 and 10 million located in the metropolitan area of Boston. Statistically speaking, probably over 50% of them lack the talent on the bench to be able to execute an internal succession plan. So 20 of those 40, if not more, will ultimately be looking to merge up, to have a firm help them with the growth for the younger partners and succession for the older partners. But there's only 3 or 4 firms large enough in Boston that are local, not local regional firms, not national firms, to take on a $10 million firm. So in those cases, it's actually a buyer's marketplace. It's very challenging, but think about it this way. As firms grow in size, the amount of firms larger than them become less and less. There's 45,000 accounting firms as members of the AICPA. 33,000 are sole practitioners. If you take the top 100, that gets you to about 36 million. If you go to the G400, the next category, it brings you to about 8-9 million. Then you have the other 44,500. So when you're $10 million, how many firms are there big enough to take you over? So that's how you look at buyer or seller's marketplace. But the aging of the baby boomers, as I said earlier, is the real fundamental issue that's going on in the marketplace, which is also impacting supply and demand. The supply of practices is increasing that are looking for succession solutions. Staffing issues exist, so the demand for them is a little bit less. But on your screen, you see some pretty crazy statistics about how many people are now looking for succession. If you're a member of the AICPA's PCPS division, you should take a look at their 2016 succession survey. Amazing statistics. Here's just a couple. A huge percentage of firms that are already making partner buyouts. Now, you see that it's only 25% of smaller firms, but remember, that's because most smaller firms are sole practitioners. They're not making a partner buyout. They don't have a partner. So it's a little deceiving of a statistic. But it's certainly overwhelming, the amount of people that are facing and looking at succession solutions. So now that we see a little bit about the marketplace, how do we structure these deals? What are the alternative options for people that are looking to slow down? I think before we get too detailed to the manner of structuring deals, we should think about, when should you start the process? When should you start to think about your succession? And this is important if you're looking to grow through acquisition or you're looking to be a seller. Whether you're a buyer or a seller, understanding these facts are very important. They start with understanding why you have your clients. You know, if I'm a client of PwC, I'm probably a client there because I'm brand loyal. Perhaps the bank said, I want an audit from PwC, but I'm going to PwC, it's a brand. If my partner retires, they put another partner in, it's highly unlikely it's going to phase my retention. But most of you on the line today are small firms. Small firms are partner loyal. So why do you have your clients? Most of them have no idea if you're competent or incompetent, because if they knew that much to measure your technical skills, they'd have done the work themselves, unless they had a test involved, which they couldn't do it. So why do you have your clients? It's because of you. Their comfort level with you. If they love your fees, raise them. They should live with your fees, but they're comfortable with you. Now, we have to transition a personal relationship as opposed to a brand relationship. It's a little more challenging. It takes a little bit more time. So one of the first questions I ask people when they're thinking about succession is, how many more years do they want to work full-time before they slow down? Not work. Most people don't go from working 2,400 hours to retirement. Most people say, hey, maybe next year I'll go 4 days a week, and 3 years from now, 3 days a week. So how many more years or tax seasons do you want to work full-time before you slow down? Let me tell you why I asked this vitally important question. In 1990, when I first started doing M&A of CPA firms, most of my small firms went out every month or quarter to see their clients. They did the work while they were there. Heck, a lot of them wrote their check, the client signed it, and they left. But now we're in 2017. And although we communicate with our clients more than we ever have before, on the cloud, fax, email, phone, Skype, etc. We spend less time physically in the same room with our clients than in the history of the profession. Accounting Today had a statistic a couple of months ago that said that 83% of accounting firm clients are only in the same room physically with their partner who manages them once a year. So if you said to me, hey, Joel, I'm 4 years from slowing down, sounds like an eternity. I remind you, it's only 4 visits. 3 years, 3 visits. And you can't transition people through the phone or through the cloud or through the fax machine. You can only transition them in person. So it's very important that you start the process early enough to have an opportunity to bring the other firm's clients and the other firm's owners and your clients into that circle of trust. It took them years to have that goodwill with you. It's going to take them some time to share that relationship. So it's really important that you give yourself 3, 4, 5 years to transition. Remember, the 13th Amendment prevents slavery. You can't buy and sell people. You need to make them comfortable. Now, if you have one of those practices that you see your clients all the time, every month or quarter you're in the same room with them, the only 1040s you do with those clients, you could transition in less of a period of time. Another thing to keep in mind is don't obligate yourself when you're closing in on a transition plan to anything you don't have to. For example, I got a call last week, and I get this call in an infuriating amount of times. It was a firm doing about $3 million in Texas who said to me, Joel, you know, we have 3 partners. 2 of us are looking to slow down over the next couple of years. We have good staff, but we don't have partner level people. I'm looking to merge into a larger firm. And by the way, we have beautiful, well-appointed space. We just signed a lease extension, fabulous parking. They'll love it. So I said to this gentleman, I said, Bob, how big of a firm do you think needs to be your successor since you're several $1 million? They said probably 15, 20 million, maybe a little more, maybe a little less. I said, don't you think they have an office? By him committing to that location, he's eliminated 80% of his audience who aren't going to want a location in the same zip code they already are. His practices might be a little too small to be a satellite office for most larger firms. And those that would consider keeping 2 offices are going to what? Reduce the offer they make to them by the cost of carrying that extra location. Where we could have absorbed them into the successor firm's office, there would have been a lot of synergies that would have enabled both the buyer to make more money and the seller to be paid more for their years of sweat equity. So be careful about investing in technology, leases, and things like that you're going to marry your successor firm to. That brings us to choosing the right successor. You know, I will tell you that in over 800 closings of accounting firms that I've consulted on, I've been involved with 0 that the successor firm didn't perform due diligence on the firm they were merging in or acquiring. And how rarely the firm merging up or selling does any due diligence on the successor firm. At least ask them why they want to merge. You think it might be a silly question, but there could be some silly answers. Here's a silly answer. I have a lot of extra space, and I thought I'd move somebody in and lower my overhead. A merger is a marriage. We spend more waking time with our partners than our staff. That's not a reason to have a merger. That's a reason to sublet someone's space. So why do they want to merge? They have excess capacity. They have good young talent. They want to make a partner. These are great reasons. Do they have the space to accommodate you? Does their technology platform make sense to you? If it's better, okay. If it's less, that's going to be a challenge. Do they have the financial strength to do this? At least run a credit report. Are they robbing from Peter to pay Paul? Because you don't want to wake up one day being Peter. Remember, bigger isn't always better. Better is better. Bigger is frequently better because you need the capacity to take on this work. But just because they're 3 times your size doesn't mean they're the right successor firm. Let's do our second polling question to make sure you all get credit for having to listen to me for this hour. Gretchen?
Hi, our polling question number 2. How many more tax seasons do you envision yourself working full-time? 1 to 3, 4 to 6, greater than 6, or until you die at your desk? I'll launch this poll. We'll give you a few minutes to answer.
If you're going to have to listen to my New York nasally sound, you might as well get CPE credit for it.
Just another second or 2 here.
Okay.
like most everybody has chimed in. I'll go ahead and close the poll. Our answers are 1 to 3 is 44%, 39% of the people have greater than 6, 4 to 6 is 11%, and until you die at your desk is 6%.
And you know that you have that right. You know, I never understood the whole concept that someone has to retire. You own your practice, you have the latitude to deal with it as you see fit. But obviously we have a pretty decent split of people that are looking for succession or people potentially looking to be the successor firm or stay alone. Hopefully we'll bring value to all. So other things to know about choosing your selecting your successor, is, you know what? Why don't you find out how they're doing with their retention rate? They can't keep their clients. How are they going to keep yours? Do they have the professional credentials and licenses? For example, if you're in the state of New Jersey and you're doing municipal accounting work, you need to be an RMA. Do they have that license? Do they have a location that's geographically sensitive for both your staff and clients to be retained? Does the culture make sense? Culture is so many things. Brand loyal clients versus partner loyal. The one firm client versus the eat what you kill type of firm where everybody has their own books of business. Culture is many different things, and I used to spend 20 minutes describing culture. And then my partner, Terry Putney, and you always want a partner smarter than you, and my Kansas-based partner is, he said, Joel, it's simple. Let's look at culture in 3 ways. What's it like to be a partner in the firm? What's it like to be a staff person in the firm? What's it like to be a client in the firm? A pretty simple way of discussing a complicated subject. You want to make sure that the cultures make sense in choosing your successor. You have the professional's capacity and skill set. If there's a language or an ethnicity issue in your firm, be aware of it. We can't all be so politically correct. I was working with a practice owned by 2 women in the Midwest a few years ago whose whole advertising and promotional campaign was women-owned accounting firm helping women-owned businesses. Well, you can't sell that to an all-male firm at this point in time. So there are certain key things to look at. Do they have the right personality, the right culture, the capacity to take on the work, things of that nature. Now let's talk about structuring the deal. How does one go about structuring a deal here? The first one that is called a straight sale. Hopefully, we're not really referring to someone selling their practice and relocating immediately. You know what? I turned that volume off. Unfortunately, it didn't work. Please forgive me, everybody. It will end shortly. A straight sale means I'm no longer looking to work full-time. I'm no longer looking to be your partner, but I am hopefully staying around to do a proper transition. Very important thing, a straight sale. So it's bad to do a sale and relocate immediately and not be there to do a transition. It's not bad if you want to get out and just work part-time or just work on the transition. It's probably the second most often deal that we're involved in. The least often is probably a buy-in to buy-out. Here's an example. Let's say I'm $1 million firm, and let's say that you're $200,000, and I want you to be my successor. Well, when we join together, we'll be $1.2 million. For you to have been an equal partner, you needed $600,000. You only had $200,000. So initially, you buy $400,000 from me to equalize, and then 3 years later, I retire. You buy me out. A buy-in to a buyout. Sometimes the buyer will use their practice as a tool to offset some of that buy-in. Sometimes the seller says, you know what, you can buy into my firm. I don't want anything to do with your firm because of liability issues or just lack of interest. A merger to a buyout's a very similar thing, except there's not an initial acquisition. So let's say I'm 800, you're 200, you're going to be my successor. We merge together. The new firm's $1 million. You own 20% equity. 3 years later, I retire. You buy my 80% out. A merger to a buyout. What's really interesting is we're starting to see some more and more of these cull-out or carve-out sales. I'll give you the 3 main examples of the ones I've seen. The first one is a stepping stone to complete succession. For example, I was with a gentleman just the other day in Southeast Florida. He had a $950,000 firm, a sole practitioner. And he wanted to slow down, but he really didn't want to completely give it up, nor did he want to be part of a firm. So we sold 750,000 of his clients to a three-partner firm. He culled out 200,000 of his favorite clients. They weren't his best paying. They were his favorite relationships, people that mailed it in the work, people that he felt he could handle without having to build up a huge staff. So he sold the clients on Exhibit A to the Successor firm. He retained the clients on Exhibit B. He had no non-compete on that. He gave the buyer the first right of refusal to buy the 200,000 that he was retaining, and the buyer agreed to give him space and an office to operate and manage the $200,000 clients he was keeping. The reason they did that, and the only thing they charged him are incremental increases in overhead, was now this gentleman will be there for the next 2-3 years to be the glue that cements the relationship in the larger portion that was sold. And now that the clients on the portion that are being retained keep coming into this office, it will be easier to transition them later. A cull-out sale. In reality, in this particular case, when you add what this gentleman is getting for the purchase price of the 750 and the enormous profit he's going to make on the 200,000 he's keeping, he's actually making the same money selling most of his business as he is working it, which doesn't always happen, by the way. Another type of cull-out sale is a niche. Last year in Philadelphia, we had a gentleman who had a very good practice. He also had a very big wealth management practice, had over 150 million of assets under management. He loved the wealth management side, really didn't enjoy the accounting side anymore. But he felt he needed them both because one was a stepping stone to the other till he attended a session that we taught. The deal he ended up doing was a carve-out sale. What he did was he carved out the traditional accounting and tax compliance clients that they had and signed a non-compete on that. The buyer signed a non-compete on wealth management and financial planning. They held it out to the world as a merger that no one firm could do, keeps on top of the day-to-day changes in the stock market and the constant changes in taxes and regulations. So Jay sent out this announcement letter that I merged with John and Jane Doe so that they could help me focus on your tax and accounting needs, and I could invest more time into your advisory needs. Tremendous way to do it. The buyer of the accounting firm even gave the seller access to some of their clients to sell wealth management to. They shared space together so that the clients would get through the transition. So this was a call out of traditional stuff and keeping the niche. And we've seen the opposite. Sell the niche and keep the traditional thing. The third type of call out sale that we've seen is really a stepping stone to handling internal succession. About 5 years ago, I did a retreat for a firm in Texas. It was a larger firm. It was doing about $8 million. They obviously were woefully short of talent to execute a succession plan, and most of their partners were aging. And although the clear need that they had was for an upstream merger, they said, we're never going to do that. We could never accept the accountability of it. And therefore, they were going to spend all this time investing in finding young talent to groom to be their successors. Unfortunately, that's a pipe dream, not a succession plan. And 4 years later, they still haven't found the talent they needed and called me up again. What should I do? And I said to them, you got to merge up. And they still wouldn't do it. So we did a operation. What we did was we took $1.5 million of their lowest paying client fees, which were very good clients, to a small firm. We took, by taking these clients that paid about 20% of the annual fees but took up about 55% of the time, we sold them to somebody else, and we retained the rest. By selling that portion, we created so much capacity, we've been able to put a Band-Aid on where the first 2 people can retire and we have the capacity to replace them now. And you may wonder, why did the clients happily go to a local competitor? Well, we explained that as a large peer-reviewed firm with PCAOB and everything else, our quality control process has to be so robust, our fees were going to have to go up. But we created an affiliation with a smaller firm that could keep your fees the same. Stay with us, get a fee increase, or go with them and pay the same. 90-some-odd% went along with the deal, a call-out sale. But by far and away, the deal that we do the most often is a 2-stage deal. A 2-stage deal came from years of failure on our part. We went around the country saying, why do you have your clients? It's because of you. It's going to take time to transition. And everybody said, yes, you're right. You're so smart. And nobody did it. Nobody would enter into the affiliation leading to their succession. And the main reason? Accountability. They've been master of their own domain for so many years. The idea of having a accountability to another firm, of when I'm supposed to come or go or anything like that, was so distasteful that they elected, as opposed to it, not to do anything. Hence, out of frustration, we created a two-stage deal. A two-stage deal is designed for people that are 5 years or less from slowing down, who don't want to give up income, autonomy, or control, but want to create a succession plan. So think of it this way. In stage one, the way we start is we're going to use an example of a sole practitioner. I'll bring it back to a multi-partner firm shortly. But a sole practitioner. So let's say we had a sole practitioner with a $500,000 practice. Let's say, including perks, benefits, the kid's cell phone, everything, they're netting 40%. Let's say they're netting 40% with the use of one full-time professional, one full-time support staff, and a per diem during tax season. So what do we know now? We have somebody who's making 40% of what comes in, using 2,400 hours of professional time, 2,400 hours of support time, and 1,000 hours of per diem time. If it was a multi-partner firm, instead of looking at how much staff they used, we would focus more on the owner's charge hours. But we're using a sole example, a sole practitioner as an example. Now let's also say this sole practitioner wants to work 3 more years and then retire. Okay, so now we've established stage one. Successor firm says to me, let's say I'm that gentleman looking to slow down in 3 years, Joel, come on in with me. I'm going to take over all your operating expenses. I'm going to pay the rent, the labor, everything. Right now, you're making 40% of what comes in. I'm going to pay you 40% of what comes in every month. And I'm going to pay it to your entity. Why? Because right now, as a sole practitioner, my entity is paying my car lease, my medical insurance, feeding retirement plans, paying kids' cell phone, whatever I'm doing. I don't want to lose that advantage. So by paying it to my entity continues to make all those payments. So, and what this firm promises me is, Joel, you come and go as you see fit. Because if you put in 3,000 hours or 2,000 hours, that doesn't impact us. What impacts us is how much labor you use. So we'll provide you with the same amount of labor you've been using, 2,400 hours of senior time, 2,400 hours of support time, and 1,000 hours of per diem time. We'll supply the same thing. And as a result of that, you come and go as you see fit. You have nothing to worry about. And because I'm paying it to your entity as a consultant, I get to take a current deduction on that. That's part of stage one. Stage one has a great advantage to the seller. First of all, it's like a practice continuation agreement on steroids, because I'm already in the successor's office. They're billing it under their new name. We're already doing a transition. So it's way better than a simple practice continuation agreement. Also, it actually mitigates some of my risk of losses. Let me give you an example. Let's say my largest client was a $50,000 a year real estate client. And let's say I lost that client during stage one. Now, before I did this deal, if I lost a $50,000 a year client, I'd probably lose $50,000 of income. I can't fire anybody. My rent's the same. My software is the same. But in stage one, I'm getting paid 40% of what comes in. I only lost $20,000. So it mitigates my loss. Also, most of the time during stage one, the successor firm is going to bill it under their name. They're going to usually gradually take over the administration, the billings, the collections, the IT issues, the HR issues. They're usually going to take it over. So as a result of that, I get to technically work less, especially if I'm not a fan of doing the admin and all that stuff. I actually enjoy it. So now what do I do with that extra time? I invested into doing a better transition. I invested into developing new clients. I invested into quality of life. But because we've had this stage one for 3 years and I'm maintaining autonomy, control, and income, I'm also doing a great transition, which is going to maximize client retention, which is going to maximize my pocketbook at the end of the day. So those are the advantages, the seller. Let's talk about the successor firm. Well, most likely on that $500,000, I was probably paying, what, 50 grand a year in rent? The successor firm probably says, I have the excess capacity to replace the per diem, maybe the support person. I'm going to save in labor. I'm going to save rent. I'm going to save software, maybe some malpractice. So usually anywhere from 10 to 25%, I'm going to save as a successor firm in synergies that I'm going to put in my pocket. Now, I will tell you, I've had certain sellers say to me, well, wait, they're saving $100,000 in overhead. I should get some of that. Realistically, no, you shouldn't. You got everything you wanted, Mr. Seller. You got autonomy, control, income, successor, everything. In fact, they're getting a reward for it. It's why they're doing the deal. Don't take away their reward. Remember, they're taking on all the liability, all the exposure. They're spending time getting to know clients, following systems, integrating. They have a right to have a benefit out of it. But this is where we have the proverbial win-win. Seller gets their goals, buyer gets their goals, and because we're having a better transition, everybody's going to retain the client. Excuse me. Stage 1 terminates and stage 2 ends based on the time frame. I had said I wanted 3 years before I slowed down. So usually in the contract that I would prepare, it would say that stage 1 terminates and stage 2 commences on the first of the following options. The end of year 3, or God forbid I had a health issue that required me to reduce my time commitment prior. That's when the purchase price starts. One of the keys to a 2-stage deal is I can't keep you whole in income, Mr. Seller or Miss Seller, and at the same time pay you for your equity. If you try and get paid for both at the same time, you're going to get less than your practice is worth and less than your time is worth. By deferring one for the other, you're actually able to maximize the compensation during stage 1 and maximize your equity value in stage 2. Usually, in addition to that, once I retire from full-time, I usually stay on in a part-time role. For example, getting paid a third of what I'm billed out for or something to that degree. And I'll usually get a new business incentive program where if I bring in new business and you want that client and you accept that client, I get a reward. So most of the time in a 2-stage deal, you have compensation keeping you whole in stage 1, equity purchase in stage 2, part-time work in stage 2, and a new business incentive program in both. This is a 2-stage deal. For a sole practitioner, we focus more on staff support, keeping that same in order for them to make the same money. In a multi-partner firm, where there's many partners involved in a 2-stage deal, we'll usually focus on their charge hours. Let's do the third polling question, and then we'll keep going on this. Question?
Thanks, Joel. Polling question number 3. In the next 5 years, my firm is likely to sell, acquire a smaller firm, merge into a larger firm, or I'm not sure. Go ahead and launch this poll. Give you a few minutes here to fill that out. Okay, looks like most everyone has voted. I'm going to go ahead and close that poll. Jill, your answers are sell, 28%, acquire a smaller firm, 6%, merge into a larger firm, 11%, and not sure, 56%.
Pretty similar to what the statistics would have been if we did this polling for hundreds of smaller firms. So we're right where we normally would be, which is encouraging, I guess. For those who consider merging into a larger firm, take a peek at some of our CPE classes where we'll talk a lot about a merger. A merger is very different than a succession plan because basically what we're doing is we're exchanging equity in one firm for equity in the combined firm. In most cases, your compensation will be kept whole if your time commitment and your revenue stays the same. But there's lots of little nuances to a merger. A merger is kind of complicated. Not brain surgery, but kind of complicated because you have everything you have in a buy-sell. Then you also have to figure out governance, how we vote for things and make decisions, profit distribution, compensation, how to admit new partners, how to buy out partners, capital requirements, treatment of AR and WIP, all sorts of fun, good things. So one of the things I like to talk about, but now that we've gone through the most often used deal structures for succession plans, is something that's a reality in most multi-partner firms. Very few multi-partner firms have all their partners in the same place of their career. For example, just last week on the West Coast, we were consulting with a 7-partner firm. Two of the partners are in their 40s. One partner is in their early 50s. That leaves us with 3 partners remaining, one of which would like to get out by the end of this year from working full-time, another one of which wanted to work 2 to 3 more years and then retire from full-time, and the other one 4 to 5. So here we had a situation where they also needed to merge into a larger firm because they didn't have the capacity to replace the partners that were leaving. But they had basically 3 different groups of partners that have 3 different goals. It was very confusing for them. It shouldn't be. If you find the right firm and you understand the deals, you create the deal for each partner. So for example, for the younger partners, they're going to exchange equity in their firm for equity in the successor firm. And of course, they've got to learn what equity means in that firm. And the best way to learn that is by looking at the ownership agreement as a starting point. The partner that wanted to get out very quickly, we're going to do an immediate sale for with an ongoing of counsel role. For the other partners that were a couple of years from slowing down, they each get a two-stage deal. So when you understand the beauty of all these different techniques, you don't have to make partners all marry themselves to the same agenda or the same time frame. It enables them to have the opportunity to choose their path. In those situations, getting everybody to agree on the same firm is always an issue, but that's an issue no matter what. Keep this in mind. The partners that are seeking succession, if they believe these are the right people to retain the clients, then they're fine as a successor firm. Don't worry about it. The real decision makers, in my mind, are the younger partners, because they're going to spend the next 20 years with these people. They should have the most to say. But the older partners still need to have confidence that the successor firm is going to be successful in retaining the clients, because in most sales, there's going to be a tie-in to retention and purchase price. So it's a very important thing. So understanding these alternative deal structures enables you to work in many different environments and bring a solution customized to each person. One of the challenging things whenever you're looking at deal structures are the inevitable roadblocks you're going to run into. And the first roadblock I wanted to speak about, because I think in many ways it's misunderstood, is time. We've heard for years that time kills all deals, but we've never really discussed the why time kills all deals. First of all, let's remember something. If I'm a buyer and you're a seller, we're in pretty adversarial position from a financial perspective day one. I want to pay the least possible. You want to get paid the most possible. It's a natural thing. There's nothing surprising about that. But what happens is when you're in negotiations for a long period of time and it starts to get extended, this adversarial nature of our positions starts to become more emotional, more challenging. Suddenly, I've had buyers say to me, sellers say to me, I don't care if they want dimes for nickels, one more change, I'm out of here. Remember something about a merger or an acquisition or succession plan. These things are much more emotional than they are professional or financial for most people. Not for everybody, but for most people. Listen, if I'm selling you the practice, you're not going to buy my practice to lose money. I'm not going to sell you the practice for free and be Santa Claus. So working out the financial things, while there's a skill set to it and there's lots of things to think about, we're going to get there. The seller's going to get paid for their years of sweat equity. The buyer's going to make a profit. But the emotional side of giving up control of all these types of things can be overwhelming. So when deals get stretched out over a long period of time, these emotions start to take a challenging effect in many, many deals. Also, I'm always concerned about the message that delays send. I'll give you a great example of a conversation I had with a firm in the Northwest not too long ago. I had a client of mine, actually it was a while ago, it was last October. I had a client of mine give me a call in the beginning of October saying, listen, I'm merging into this bigger firm. I was thinking that maybe I should look at their employment handbook. I want to see where their perks and benefits are different than mine. A very lucid, appropriate question for him to ask. So I called up my client, who was a top 100 firm, and I asked for this employee handbook. And he said to me, well, you know, Joe, we have October 15th next week. Then I'm going away for a week. I'll get it to them at the end of the month. First, I was shocked because I'd be shocked if this managing partner of a top 100 firm was doing anybody's extensions. But beyond that, I said to this gentleman, I said, let me ask you a question. Do you have any clients that pay you over 100 grand a year? He said, I do. I said, so if a client who pays you 100 grand a year called you up and says, I need you to email me something that's right on your computer or on your office manager's computer, you'd say it's going to take them 3 weeks to get it? Well, he blew up on me. He was furious with me. How do you compare that? This is a client that pays me and everything. I said to him, John, this is a $6 million firm you're talking about merging in. They're your biggest client. And you're sending them one of two messages. Either I'm so damn busy, I don't have the time to take on $6 more million, or this is such a low priority, I'll get to it in the next 3 weeks. Thankfully, he understood. I wasn't trying to berate him. I was trying to protect him, because this is what I hear frequently. What do you mean I can't get that for so long? When you're thinking about merging up or selling, it's very rare there's anything on your desk more important to you than that at that moment. When someone doesn't treat it the same way, it has a bad reaction. Also, as time gets extended, leaks start to happen. Staff start to find out. Competition starts to find out. Also, even with contracts. I mean, the 13th time you read the contract, suddenly it says something it never said before. It's very important that while we recognize a merger acquisition process is a bit of a marathon, not a sprint, it's very dangerous to have long pauses in it. You need to keep the momentum going. I will tell you, from the time two parties meet each other that I'm consulting on, it's only usually 2 to 3 months till we have a complete oral agreement, because we focus on it. It's a priority at that time. The roadblocks that you run into be things such as unity of partners. Sometimes you have one partner that handles a lot of it, and then at the end of the day, they go to speak to the rest of the partners, and the conversation doesn't go as well because everybody wasn't on the same page. Capacity is an issue. If I've got 5 partners and 3 of us are retiring, do you have the capacity to replace all of us? Even if I'm a sole practitioner, a lot of times as a sole practitioner, clients are used to dealing with me, the principal. Am I going to sell it to a firm that the partners don't have the capacity? Are they going to expect juniors to talk to clients that are used to dealing with the principal? Having patience, understanding the emotional decisions that have to be made, understanding each of us are running a business. These are things that are also important. Sometimes in the transition, which we'll talk about a little bit more, staff packages are really important. For example, my staff gets 3 weeks paid vacation, yours gets 2, but you're the larger firm. When I merge in with you, we can't have 2 different packages. By the way, a simple solution to that is my staff gets a week's payroll increase. So then they take 2 weeks paid vacation. If they take a 3rd week without pay, they're whole in income. Another roadblock can be IT. IT has become a culture in itself. It's very important to certain firms that your IT platform makes sense, because the idea of having to bring you, if you're not on the cloud, you're not paperless, you don't have multiple screens, to that plateau is going to cost about $10,000 per staff person to get them onto that platform. It's also got other factors to it. So it's very important that you avoid these types of roadblocks. Other types of roadblocks that we talk about, obviously, are also the equity. Equity could become a real issue to certain firms. And the first thing I tell you that you need to think about is, what does equity mean? For example, a couple of years ago in California, there were 2 firms merging together. Just to simplicity of numbers, one was 32 and one was 8 million. Could have been 320,000 and 80,000. It doesn't matter. The larger firm called me up and said, listen, we've agreed on everything, compensation, name of the firm, everything, but we can't agree on equity. He said, my firm's 32 million, has a better infrastructure, more invested in technology, a better brand, better realization, blah, blah, blah. On the same phone was the managing partner of the smaller firm, and they said, well, what do you want to merge with us if we're that horrible? So they decided to hire me to Big King Solomon to make a decision of how equity would work. I'll tell you what I did. I asked for the partnership agreement that they were using, which they agreed was the larger firms. First thing I looked at was voting. In that firm, it was 1 partner, 1 vote. So my equity position didn't matter. I looked at profit distribution. The way they did profit was 1/3 equal to all partners, 1/3 based on a real anal formula that was very objective, though, about realization, new business development, mentoring, all sorts of things. and 1/3 was based on a compensation committee that rewarded people. But again, if I was 1% equity or 20, didn't change my profit. My buyout was looking at the last 5 years' income on an accrual basis, taking an average of it, multiplying that by 3 and paying it over 10 years plus capital over 5. So my buyout wasn't based on equity. Called them up. I said, what are you fighting over equity for? The easiest $5,000 I ever made. So be careful what you ask for with equity. First of all, know what it means. If I'm slowing down over the next 5 years or less, what do I want equity for? I shouldn't want equity. If I could be held out as a partner, still have reasonable autonomy, control in my income, the only thing equity gives me is liability and exposure. I'll share with you another falsehood in the profession. The name of your firm is very rarely all that important. They're loyal to you. They're not loyal to the name of the firm. You could worry about the messages it sends. I'm going to show you a way to overcome that before we end our presentation today when we talk a little bit about client retention. But the bottom line is, it's not the name of our firm. It's the message we send. We're sending the right message. They're not worried about the firm name. Biggest roadblocks are always must-haves. I must have my name in the firm. You must keep my office manager. She makes 150 grand a year, has 16 weeks paid vacation, but she's been with me for 50 years. You got to do this. You got to do that. Always look at what you think is a must-have. Make a decision. Is it a must-have? Is it a strong preference? Is it a preference? Must-haves that exist, bring them up day one. Don't put them out there for later. Hey, I'm on this lease personally. If you're not going to take it over, you're not buying my practice. I get that. Don't hide them. Just you'll waste time. Put them up front. And also remember, some cultures are harder to mix than others. If my firm's a one-firm client mentality, there is no my client, your client. We all share the clients. We all work on them together. We have relationships with them all. And yours is much more of the eat what you kill type of thing. That's a hard thing to combine. It's very hard to take someone who's all time and billing and put them with a value billing or put them with a retainer firm. Some cultures are very hard to mix. It's just the way it is. It's just one of those roadblocks you have to be aware of. What things you could do to make your firm more attractive? That's always an important thing to keep in mind. The first thing you could do is embrace technology. Firms don't care if you're on the same software product that they're using. They prefer it. They care that you're at the same level. Let me give you a great example. I was working with a firm in New England that was looking at 2 small firms. They said to me, Joel, one of these firms, the metrics are great, but they're not on the cloud. They're not paperless. I got some problems with this. The other firm, he said, the metrics weren't as good. They weren't as profitable, but they fully embraced the cloud. They're multiple screens. They're paperless. They have virtual offices where people can work remotely. They have flex hours. He chose the firm that had embraced technology. Now, because I'm cheap, I figured, is that because, I asked the buyer, I said, is that because you didn't want to go through the expense of getting them onto your technology platform? He said, no, not at all. He says, it's because it took me 10 years to get my staff and partners to throw out the paper, to get on the cloud, to get comfortable with remote access. I don't want to take a step backwards in culture. I can help them be more effective. I can help their metrics become more profitable and more efficient. I can't make them throw out the paper. So believe it or not, embracing technology makes your firm more attractive as a buyer, seller, merging, and merge all. Trying to get your clients comfortable with other people. If you're the only person in that firm that client's comfortable with, it's an obstacle. It's going to make your practice less attractive to someone. Hey, you may not be able to get out of that. I understand that. But the more you can share a relationship, the better. The more trained clients you have, the better. I was meeting with a firm in DC not too long ago, and I asked them about what their net was, and they said whatever's left. Now, they had impeccable records of their clients' businesses. They had terrible records of their own. Their clients weren't well trained. Their receivables were horrific. Their work in process was out of control. You know, their clients paid when they wanted to pay, got them the information when they wanted to get the information. This did not make for an attractive practice. You know, I get loyalty. I get we get comfortable. But having a good practice, knowing what you have, knowing your metrics, having realistic terms of These things make your practice more attractive to somebody else. The most important thing is always retaining the clients. The truest measure of success of any deal is always client retention. So let's start by understanding what are the fears a client has. It's usually, is the person I trust still there? Is it going to cost me more money? Do I now have to drive 2 hours to meet my practitioner? For those that are used to working with certain staff, are they going to be there? Are they part of the deal? Understanding these fears is very important. To create a proper transition plan, one of the keys is making this about the gain of the successor firm, not the loss of mine. So I look at those 4 fears. Let's take an example. Let's say I was selling my practice to Gretchen. And the first thing I'm going to do as a seller is I'm going to divide my clients into categories: doctors, retail, wholesale. Let's say the first category is doctors. The announcement letter I create might say something like this: I'm pleased to announce that I've merged my practice with Gretchen. Gretchen's an expert in the Trump tax laws and the modern computerization of accounting, especially as it relates to the medical community. As a result, we'll be able to offer you additional services, yet maintain the same fee structure. I remain the principal in charge of you as a client. The same staff you're used to dealing with are part of our combined dedicated team of professionals, and we remain geographically sensibly located here in New York. So in the first paragraph, I said to them, I'm still here, the fee's the same, my staff's here, we're in the same area, but I have more I can do for you. The greater the loyalty between the clients and the owner, the easier it is to retain them when you take advantage of that loyalty instead of fearing it. Then you got to take it further. Who gets a phone call? Who gets a visit? Who gets a letter? You don't send an announcement letter to your biggest client, nor do I go there alone. 1992, I had someone go to a client alone and they said, hey, congratulations on the merger, but Mike, you're the only one who deals with me. If he would have brought his new partner with him, the client would have said, nice to meet you, never want to see you again. In 1995, we sent out a beautiful announcement letter that went in the buyer's envelope and nobody opened it. They all thought it was a solicitation. Since then, we put it in the seller's envelope with the new stationery inside to make sure it gets opened. Even how you answer the phone, you can't answer it with the new firm name day one. Maybe accounting office, or you've reached the offices of Joel and Gretchen. Can I help you? Even as we discussed and alluded to with the name of the firm, maybe at the beginning it'll be Joel Sink and CPA PC division of Gretchen. Gretchen doesn't have to change her firm name. Maybe at the beginning we have a division of just to get us through things. What we want to do is remember that everybody hates change. This isn't about loss, it's about gain. It's not about anything other than us being able to deliver a better service to you and protect you over a longer period of time as your most trusted business advisor. These are some of the key things we wanted to focus on. Let's do our last polling question and wrap up some of our business today.
Thank you, Joel. Our final question: your most likely personal succession plan looks like find an external buyer, selling internally to partners or staff, or I have no idea. I'm going to go ahead and launch this poll. Wait for your answers. Just another second or two here. And it looks like just about everybody has put their votes in, so I'm going to go ahead and close this poll. And your answers, Joel, are find an external buyer, 21%, selling internally to partner or staff, 58%, and 21% have no idea.
I'll tell you what, it's great when you have an internal succession solution, and those deals are structured very, very differently. They're valued very differently, and that's really good. Just always make sure that you're confident that you have a real succession plan that's going to work. And remember, in all deals you do, the 4 C's. If you don't want to eat lunch with someone, you shouldn't do a deal with them. If they're going to make wholesale changes that the clients see right away, that's bad. Clients like the way your ship is sailing. If they're going to change the direction overnight, that's a bad thing. Does the culture make sense? Do they have the capacity? These 4 C's or how you choose a mergee, a merger, a buyer, or a seller. And remember, good deal's a fair deal. The seller should be paid for their years of sweat equity. Buyers don't do deals to lose money. And everything's a package, how you put it all together. And today, there's also great value in the staff. If you have good staff with capacity, it actually does make your firm even more attractive. On your screen right now is, if you're a member of the AICPA PCPS division, they've put together a great succession planning resource center. They have a voluminous amount of tools and information, and they have a 9 or 10 or maybe 11 chapter book that Terry and I wrote. Has great information. If you're a member, it's already free. Go take advantage of it. Also on our website, under the resource section, there are dozens and dozens of articles: how to value a practice, structure a deal, internal succession planning, what to look for in due diligence, ownership agreements. Help yourself. Go in there. It's all free. You don't have to register or anything like that. If there's any questions anybody had, because of my run-on mouth, we've already hit the 1 hour. I will email you. It may have to be Monday because I'm out all day tomorrow, but send us your questions. We'll get you the answers. Thank you very much for participating today. Do we have any closing business that you need to go over, Gretchen?
Just a few things. As a reminder, the survey for today's webinar will pop up on your screen once I end the webinar. That survey is a requirement for CPE, so please take a moment to complete it before you close your browser. Assuming you've met both of the CPE requirements, you will receive your certificate by email from my colleague, Nikki Johnson, sometime next week. If you have any questions, you can reach her by replying to any of the reminder or follow-up emails you've received. And that's all I have, Joel.
Gretchen, thank you very much for jumping in and helping us out today with Nikki unavailable. It's like Lou Gehrig. You took over and did great. She might be Wally Pip. But thank you all very much. Hope join us next month for the next webinar. Have a great day, everybody. Thank you.